All right, welcome to our explainer. Today, we're jacking into the credit card rewards matrix. We're going to peel back the layers, see what really powers the system, and figure out how you can actually beat it at its own game.
You've heard the promises, right? Flights to Paris, incredible hotel stays, hundreds of dollars in cash back, all for spending money you were going to spend anyway. It's so intoxicating. It feels like you found a glitch in the system, like you're getting something for nothing. The card companies love to call it free money, and honestly, for millions of people, that's exactly what it feels like.
But you know how it goes. If something seems way too good to be true, it probably is. That free money has to come from somewhere. So who is really paying for your sign-up bonus? Who's footing the bill for your cash back? Answering that question, well, that's the key to understanding this entire game.
So, to get our answer, we have to look past all the shiny marketing and dive right into the raw economics of how credit cards actually work. And it's a playbook that's built on two absolutely massive revenue streams.
Okay, so the whole business model really has two main engines. The biggest one? Interest. We're talking about cardholders who carry a balance from one month to the next. In 2022 alone, that generated over $105 billion in interest for the banks. I mean, that's such a massive amount of profit, it can basically fund the rewards for everybody. The second engine? Well, that one is fueled by the stores you shop at.
So every single time you swipe your card, the store, the merchant has to pay a small percentage of that sale back to your bank. That's called the interchange fee. And here's the really crucial part. Premium rewards cards, the fancy travel ones, they command higher fees. So when you use your high-end travel card, you're actually making more money for the bank, and so they kick a little piece of that back to you as a reward. This is the engine that funds the system, even for people who never ever pay a dime in interest.
But this system has this really fascinating ripple effect across society. Think about it. To cover the cost of all these interchange fees, merchants have to build that cost into their prices. So what does that mean? It means they might raise prices just a little bit for all of their customers, no matter how they pay. And the result, as some economists have pointed out, is that people who use cash or low-fee debit cards, who often tend to be in lower-income households, are, in a way, subsidizing the free flights and fancy hotel stays for people using those premium rewards cards. It's a concept that's been nicknamed the reverse Robin Hood effect.
So really, this whole ecosystem boils down to two kinds of players. On one side, you've got the transactor. This is the person who pays their balance in full every single month. They never pay interest, and they actually profit from the rewards. But on the other side, you've got the revolver. This is the person who carries a balance and pays those super high interest rates that, as we saw, fund the entire system. The profits from the revolvers literally pay for the perks of the transactors. The two are completely linked.
Okay, so now that we've peeked behind the curtain and we get the game theory, let's talk about how to play it to win. This is where we shift from just understanding it to actually making it work for you.
Now, before we get into any fancy strategies, we have to talk about the golden rule. This is the absolute non-negotiable foundation of winning the rewards game. You must pay your balance in full, on time, every single month. If you don't do this, the game is over before you even start. The ridiculously high interest rates on these cards will always wipe out the value of any rewards you earn. Break this rule and this whole thing becomes a losing proposition, period.
With that golden rule firmly in place, the first real strategy is to match your card to your life. Seriously, don't change your spending to fit a card. Find a card that fits how you already spend. If you want things simple, a flat rate card is great. It gives you a solid 1.5% or 2% back on everything. Easy. If you spend a ton on groceries and restaurants, a tiered card that rewards those categories is going to be your best bet. And if you're super organized and you don't mind a little homework, a rotating category card can give you the highest return, sometimes 5%. But you got to track the categories and remember to activate them each quarter.
And for the really advanced players out there, there's a strategy called 0% APR arbitrage. Here's how it works. You get a new card that has a 0% introductory APR offer. You use it for big, planned expenses. But, and here's the key, instead of using your cash to pay off the card right away, you stick that cash in a high-yield savings account where it can earn interest for you. You just make the minimum payments on the card each month. Then, right before that 0% offer expires, you take the money from your savings, pay the card off in full, and you get to keep all the interest you earned. It's pure profit.
But this brings us to the other side of the coin. Because chasing these rewards, it's a pretty high-stakes game. The upside is nice, for sure, but the potential downside is severe. Welcome to the gauntlet.
This number, $1.16 trillion, that is the total amount of outstanding credit card debt here in the United States. It's just a staggering figure that shows you how many people get caught in the debt trap these cards can create. Right now, almost half, about 46% of American cardholders are carrying a balance from month to month. And you can bet a lot of them are chasing rewards.
And this is exactly why that debt is so incredibly dangerous. The math is just brutal. A 2% reward looks microscopic next to a 22% interest rate. The risk is just completely lopsided, right? Your potential upside from the rewards is pretty small and it's capped. But the potential downside from getting into debt, that's exponential, and it can be financially catastrophic.
And beyond just the debt trap, chasing rewards can ding your credit score in other ways. Every time you apply for a card, it creates a hard inquiry on your report. Opening new cards also lowers the average age of all your accounts. Both of those things can drop your score. Then there's the risk of being labeled a churner. That's someone who opens and closes cards just for the bonuses. The banks are really cracking down on this, and they have the power to just shut down all your accounts and take back all your points if they think you're gaming the system.
So, after looking at the economics, the strategies, and all the risks, where does that leave us? Well, what it really shows is that there's no single best way to get value. Instead, there are two really distinct, successful paths you can take, and each one reflects a totally different philosophy.
Let's look at two classic cards to see what I mean. The Chase Sapphire Preferred card. That really represents the traveler. Its value is aspirational. It's found in transferring points to an airline for that dream vacation or in the peace of mind you get from its travel insurance. On the other hand, a card like the Discover It Cashback represents the strategist. Its value is purely transactional. It's a direct, tangible cash rebate on your everyday spending, and you maximize it with disciplined, quarterly planning. Which one is right for you really depends on your financial personality. Are you optimizing for life experiences or for cold, hard cash?
So, here's the most crucial takeaway. Credit card rewards are not free money. A much better way to think about it is like a dividend. It's a return you earn on your own financial discipline, on your strategic planning, and on your constant risk management. It takes real effort, it takes organization, and you have to understand the system you're playing in, which leaves us with the final big question you have to ask yourself. Is the work worth the reward?